Hey everyone, it's Nick Karadza here, and we had a little bit of trouble with our trusty whiteboard over here, so we got to use the flip chart today. You know what? We have the next episode of the Rockstar Real Estate TV coming out, but this was kind of so important that we had to put a quick video together just to kind of explain what's been going on. So in the last week, there's been a couple big developments that have happened that really impact us as real estate investors, as property owners, as anything. And if you've been anywhere around a financial headline, you would know that the U.S. debt has been downgraded by Standard & Poor's. So they've basically come out and said, it's not like the absolute best type of person that you can ever lend money to. There is some sort of risk that they may not pay back all of the interest that they owe you, or maybe not pay back all the debt. They're just saying that there is a little bit of risk there. And there's good and bad to this, and there's different views of whether they should have done this or not, but let's just look at it as why they've done this, what's going on. So here's let's just pretend this is an imaginary graph of the U.S. debt, all right? And the U.S. debt has kind of generally just chugged along pretty low, and then 2000s it started kind of spiking up, and then last couple of years has really kind of gone like that. Okay, so just the U.S. has debt just like anyone else, and they have interest on this debt. So the people that loan them the money they get interest payments back, and those interest payments have been, as we all know right now, are like historical low levels. Okay, so here's what we're talking about. Hold on, let's just go here. We're talking about the U.S. debt downgrade. All right, hope you can see that. Probably not, but I wrote it anyways. So here's the way their debt is. It's just exploding. And right now, the interest rates are at historical low levels. So they can make the interest payments on this debt because the interest rates are a little bit low, right? So what happens when these interest rates go up, though? That's what people are asking. Say, hey, you know what? You have all this debt. Your debt has grown this much, and yeah, you're making these payments, but do you have enough revenue coming in to continue to service this debt? Just like banks look at us when we're trying to buy properties, it's the same thing. And what's happened in the U.S. is because of the economic slowdown, with less employment and less people investing in different things, that there is less revenue coming into the government. So the revenue has dropped, right? So revenue now has dropped for the U.S. government, but the debt is high. Now they're able to service it because interest rates are at an all-time low. But what happens if those interest rates start to move? That's what we start looking at. So here's the way this works. Because what happens is now, and this hasn't happened yet, and it's the trend that people are watching out for. So it may happen in a couple of years' time, but this is what it's like a long-term outlook. This picture. But what happens when people say, "Hey, listen, you have all this debt, interest rates are so low, but now I'm not so sure if you're going to be able to kind of service this debt properly. I want a little bit higher interest rate on the money that I'm going to loan you. I just want a little bit more." So interest rates start to creep up. Right, that's what drives our long-term mortgage rates as well. So this is why this type of things interests us, not just for the health of the U.S. economy, but that drives long-term mortgage rates as well. These might be long-term mortgage rates for the U.S., but if you look historically between the U.S. and Canada over the last 30 or 40 years, I think there's only been about 3 times that the interest rate trend in Canada has differed from the interest rate trend in the U.S. So right now, Canada has kind of just slowly started trending their interest rates upwards. There's been a couple quarter-point increases, right? Whereas the U.S. hasn't moved their interest rates anywhere. They've basically been at zero for a number of years now. So they're trying to keep it rock bottom. Canada's trying to increase theirs slowly because they're trying to slow down the economy. But they're unable to because if Canada puts their interest rates up too high and the U.S. ones are too low, a lot more foreign investment will come to Canada, and it drives the dollar up, which is exactly what we've been seeing. So, and then when the dollar goes up, our exports that we sell to the U.S. become more expensive, so we're a little bit less competitive to the U.S., and it slows down our economy. So they don't essentially really want to do that because that affects jobs and stuff. They want to slow things down without affecting that side of things. So this whole picture of the U.S. interest rates really matters to us. Right? So if these interest rates start to rise and we can't service this, and because of the increased perceived risk of this debt, people are asking for more return on their investment. That's what the term like the bond yields that they're looking at. That's what they're talking about. And if those start to go up and those long-term interest rates go up, that starts to really kind of change things a little bit. So we want to look at that. So as investors, that's the type of thing that matters to us, right? So that's one thing. That's the U.S. debt. But these U.S. rates, this is the other thing that we've been talking about, right? So what happened now with the U.S. rates is that the Federal Reserve came out and they basically took a page out of Mark Carney's playbook. So a couple of years ago, maybe a couple of years ago, a year and a half ago, I'm not sure if you remember, but Mark Carney actually came out, the president of the Bank of Canada, came out and said, you know what, we're going to keep interest rates low for an extended period of time. And what that did is that told everyone, say, you know what, you can borrow money right now because we're going to keep rates low. You don't have to worry about rates going up. We're going to keep rates low, and that way you can borrow money and you can service it. So don't worry, if you want a house, no problem, go get it. You want to do renovations, no problem, go do it. Whatever you want to do, cheap money, let's flood the market and get the economy going. That's what they're trying to do, right? So now the Federal Reserve, because all this stuff is going on, they need to take something else out of their playbook, and they actually took a play out of Mark Carney's playbook, and they've come out and said they're going to keep rates low until 2013. 2 full years. They said they're going to keep their interest rates low. Now, if you go back to what we just talked about, remember what we said? Canada has only strayed from the U.S. interest rate trends a few times over the last 30, 40 years. So the chances of them doing it again are very slim because they don't want to pump up their economy, because if Canada raises rates, more foreign investment comes in, right? Canadian dollar goes up, we could become less competitive with our exports to the U.S., all this stuff starts happening. So that's the type of stuff we want to focus on. So here's what happens. Now, over the long term, here's the scary part. The U.S. debt there's all this kind of colored in part here. Now, as the debt has increased, the U.S. debt is now all this stuff, right? So what happens when interest rates start to rise? Are these still going to be able to service this debt? Right? So if interest rates rose today, and they start to rise quickly today, the U.S. would be in a lot of trouble because they wouldn't be able to service their debt. That's why they need to hold down these debts. That's why the Federal Reserve prints this money to buy into the markets. And there's all sorts of technical things that I'm skipping here. That's for a longer conversation. But they buy into the markets to keep these long-term rates low, to show demand for these things, to keep the rates low so they can service this debt. Right? So that's what's happening, because what the U.S. needs to do is they need to get rid of this debt before they can start raising interest rates, and then they can start raising interest rates because then they can service the debt again. So that's why these things matter. So this announcement, there was a much smaller headlines that came out on Tuesday, as opposed to the big headlines with the U.S. debt being downgraded. The U.S. rates being held very low until 2013 has huge implications for us as investors, right? So that's the type of stuff that Tom and I look at when we're trying to make our investment decisions, and we're renewing mortgages, we're acquiring more properties, whatever we're doing. That's the type of stuff we want to look at. So we want to see how these things impact us, and then we use that to make our decisions. Again, make your own decision, but we just want to explain to you what's going on with this stuff and the way that we view these things, right? This is the type of stuff that we'll be going over in much more detail at our upcoming member event. It's going to be an awesome one. There's so much crazy stuff going on, especially with what's going on in Europe as well, and how this all comes home to really kind of tie it together to impact us. We've booked the date now. It's October 6th. It's coming up, so kind of save that date in your calendar if you're a Rockstar Inner Circle member to come out to our member event, and we'll be going through way more stuff like this, and it will pinpoint exactly how it hits home. But yeah, we wanted to touch on that. It was important stuff that's been going on this week. So hopefully this gives you an idea of why it's happening, how it impacts us at home, and what the long-term outlook is for us. Because in today's environment, until this debt thing is really sorted out in the U.S., it's going to be very, very difficult for either the U.S. or Canada to start really increasing interest rates. And when I say increasing, I mean by multiple percentage points. If they go a quarter point here or there, that's small stuff. But for interest rates to really spike, unless inflation gets totally out of whack, like crazy out of whack, the chances of it happening, in our opinion, seem fairly slim. So that's it for today. Until next time, everyone, your life, your terms.